Hello and welcome to today's presentation on the state of the markets, a look back at 2024 with maybe some insights into what's going to happen in 2025. Although we have a major wild card with the change of administration, so what's going to happen going forward? Well, that's just about anybody's guess. But there are some tea leaves to be read that might be able to provide us some guidance on where to be looking for 24 or 25 and trying to understand exactly what's happened in 2024. So as we get started here today, first of all, I do need to say a few things about disclosures and things that you need to understand that what I am talking about tonight is general information only, not specific to your situation. If you are a client of mine right now, well, then we can have that conversation as it pertains specifically to you when it's convenient for you or at one of our regular scheduled meetings. Obviously, you can always call me. And for those of you that are not clients of ours, just take this all with some grain of salt, as it were. You can't apply exactly what we're saying to your situation, but you can draw some conclusions for yourself. So again, I'd like to welcome you to our conversation tonight as we get started. First of all, if you don't know me, my name is Greg DuPont, and I have been a financial advisor for about 20 years now. And so today we're going to look back at 2024 and again, see what happens going forward in 2025. Our agenda tonight is very simple. We're going to talk about how stocks performed in 2024, which sectors went well, which ones maybe not so well. We're going to look at what drove market performance in 2024, so you might be able to draw some lines into 25. We're going to look exactly at where we are now and what do major firms forecast for 2025 going forward. So that's our agenda tonight, and we'll get right into it and then talk about how stocks did perform in 2024. So once again, we find ourselves in a spot where the market surprised most of the experts. When we look at 2024, when we're doing a poll of the leading investment firms out there, Morgan Stanley, JP Morgan, RBC, BOA, et cetera, well, their consensus was that the target for the S&P 500 for 2024 was about 4817. Well, we actually ended up at 5881, or a gain of 23.31% in the S&P 500. Now, this is 2 years in a row where the S&P surprised all of the leading minds in the investment world. And does that come as a shock? Yeah, we're going to look into a little bit of why, but for the last couple of years now, the industry's been waiting for the other shoe to drop. What was going to happen in recession? Those type of things, and it hasn't materialized. And when will it? We don't know. Is it 25? Well, that's not what the consensus is, but the consensus is, as you saw last year and the year before that, as a matter of fact, doesn't know what really is going to happen because we have no crystal ball, right? But what we do know is what has happened. And I want to share with you the different sectors of the investing world and how they all performed in 2024. So as I mentioned, the S&P 500, about 25% for the year, depending upon when you pick the first and end dates. The U.S. growth stock market was up 36% last year. It was a great year for growth stocks. Value, about 12%. Mid caps, 13%. Small caps, 8%. International funds, 3.82. Emerging markets, 7.5. So you see that it's not, we talk about the S&P 500 as the market. That's the way that the press for the industry tries to make it simple for you. But it has many sectors. And we look at fixed income, bonds, and those type of things. The returns last year, well, if we were in long-term treasury bonds, we had a rough year, a loss of almost 8%. So we need to be thinking about our investing profile and where we have our funds more, shall we say, granularly than just talking about the S&P 500. So when we look at the basic areas of the investing world, again, growth was up 36%, S&P 500 25%, small cap 12%, international growth about 6%. So one thing that people are looking at when we're talking about what happened in 2024, we're looking about learning how to invest, how to play the market, for lack of a better word, understanding that the market is made up of many different sectors. So as we look back to 2024, what they call as a quilt is showing you is the various individual sectors of the market, how they change from quarter to quarter. So for example, fourth quarter of 2023, real estate was up 18%. And then you turn to the first quarter of 2024, it was down 5%. Second quarter, down almost 2%. Third quarter is up 17%. Fourth quarter, down 8%. So just that one example, as you look through, there are many of examples like this, how the value from one quarter to the next of a sector can change wildly. And this is part of the dynamic that we're dealing with the market right now. This is the domain of traders, where they are taking advantage of these trends on that short level. Now, most consumer investors, like most people that we work with, people that watch presentations like this, they're buy and hold. So we need to be thinking about the long term and not get too, shall we say, excited about these variations as they go from quarter to quarter. So what's driving all this? What was there for us in terms of big picture items, so that we might be able to draw some lessons into 2025? What were the factors that were driving that performance? Mostly what we are seeing is the evolution of the stabilizing, shall we say, of the corporate gains, and we'll talk about that in just a second, and trying to normalize that with the normalization of the inflation and the Fed. Okay, so as you see, the S&P 500 last year, for the most part, it was on a downward trend or an upward trend for the entire year, with a few little wrinkles here and there. The S&P 500 has been driven still by basically NVIDIA, Microsoft, Apple. They call it the Magnificent Seven. Okay, but we've had some responses. The CPI at 3.4% year over year started getting people back in January of last year seeing the end of the inflation cycle and the hope about what would happen with the Fed and the decreasing of interest rates. And so when July came around, inflation was a 3-year low, and the unemployment was going up to new highs relative to the recent years. Now we started seeing stress and tension back in the market, which ended up with in August with a drawdown of the S&P 500. But the Fed, when they started cutting, and they cut the 50 basis points in September, the first cut in 4 years. Now the market said, okay, we're excited again. We're seeing that the Fed believes that they've got inflation under control, and they're going to start loosening up money, which is going to help them help the economy grow, et cetera, et cetera. Understand that the market is basically looking forward. When we look at a valuation in September of 2024, what that is theoretically talking about and what the market is theoretically reflecting is what the consensus of the market in terms of the people buying project the value of the stock will be in the future. Typically, the kind of the thought process is what's that going to be looking like a year in the future is what's being reflected here. So at that point in time, people were starting to think that, okay, it looks like things are going to get better a year from now than it is now. And we saw that continued cycle with the additional rate cut in November, and then the election, which spurred more hope coming out of that, of change and growth. So we are at all times need to recall and understand that the market is basically a measure to a great degree of consumer emotional sentiment. And the more that those animal spirits, as once referred to, are thinking that things are going to be good and growing, Now it's reflecting in the market. But there are trends that we need to look at underneath the the hood, as it were. Quarterly earnings. Part of the reason for last year's growth of the market was a renewal of growth of quarterly earnings. So we had a mini recession of quarterly earnings in the 23 era. And then last year we started seeing that the quarterly earnings reports showing the S&P 500 were starting to be more profitable. So we were starting to see the effect of the increased use of AI in terms of some of the bigger companies and being able to project that we have greater profitability. And so that's what we started seeing a trend in the end of last year that many experts are continuing to go forward into 2025, absent any major shocks. We look at the overall strength of the economy and the health of that. So we look at certain key economic indicators. What's the growth of GDP? Well, if we look at the 4 quarters of last year, the GDP growth was 1.6 in the first quarter, 3.0, 3.1, 1.7. The GDP growth overall, many times they have to move that back and fix those numbers later, but it was growing, but not strong growth. That was good enough for the market and good enough for the government to start feeling like, okay, they've got, government meaning the Fed, got the balance between the Fed's mandate of growth as well as employment under control enough that they're able to reduce the interest rates. You see that there was that uncertainty throughout the middle of last year, Q2, Q3, and Q4. Unemployment rates started to climb up a little bit. People were not sure how they were going to respond to that. Inflation, accordingly, was going down until we started seeing some shocks in the supply chain in the fall because, again, of shipping issues and things like that. The consumer sentiment issue, that is that measure of how confident we are about the future. And you see that those numbers actually were fairly high going into the fall. So all of those indicators are showing that we've got 2024 was a year that we had a good level of optimism, not an over exuberance, and we had a fairly well balanced growth pattern between the Fed and interest rates and inflation. So that's why the 2024 ended up the way it did. Whereas going into 2024, most experts didn't think that the Fed was going to be able to pull that off. There is one trend that is not reflected in those numbers that is very important for you to understand in terms of your picture going forward, and that is where money is. So right now, we've got a whole lot of investable money that's sitting in the sidelines. Last year, because of the high interest rates, we still had a lot of money that's sitting in money market funds. Between bonds and money markets and non-equity positions, we are at new records. So what that means to you as an investor is if we have increasing growth of consumer optimism and investor optimism, and we have a decrease of the amount of money that is sitting, a decrease in the interest rates being paid on those money market accounts. Now we have even more money that's going to go into positions trying to find return. And right now, where we have a money market account where we can get, call it 4%, we have very little incentive to be putting that into the market if we've got some risk aversion. But as those money market rates go down, there's going to be more money that's going to be pushed trying to find places to put it. And supply and demand being, as it were, that has the effect of potentially building a momentum to drive up the market. So all those factors that are coming out 2024, let's just kind of put them in perspective. Where are we now? Where are we going? And as I mentioned previously, the experts, they've got some visions, they've got some hindsight, but their crystal balls are no better than you or mine. Okay, so what I'm going to show you in the next couple slides here are the outlooks from a combination of leading minds in the market as to what they're looking at in 2023. We have monetary policy was in a negative position. The economic outlook was neutral position. Yield curve was neutral. Consumer sentiment was neutral. See in this graphic, 1, 2, 3, 4, 5, 6, 7 of the major indicators were all negative. So going into 23, the analysis was we are in for a rough ride. Now with the same pool of minds regarding the market, we look at January 2024, a year ago. You see that the sentiment on that, now we've only got 3 situations: the international economic outlook, the equity market valuation, and geopolitical risk, only had 3 factors that they felt were negative. Everything else was neutral, bordering on positive. So going into 2024, although there was some serious concern about those 3 risks, there was a brighter perspective. And now, coming to that same pool of investment minds, we look at January 2025, and we see a lot of positive energy here. We see that monetary policy is positive. Why is that? Well, it's because we're at the point where we feel pretty comfortable that the Fed's inflationary fighting is working and that they will be dropping interest rates even more throughout the course of the year. Economic outlook is in good shape. The U.S. economy is dwarfing the recovery of any other economy. We can complain as much as we want and have concerns about where the future may be, but the fact remains that competitively we're kicking some rear. Consumer sentiment started picking up at the end of last year, coming into this year. So now we have positive forces out there. We have a lot of people that are feeling better about themselves and what the future looks like. The labor market is strong going forward at this point in time. We have low unemployment rate. We've adjusted to the COVID situation and the post-COVID era, and now we're starting to go back to being employed at the office. We have fiscal policy that has a positive bent to it right now, but that was, only time will tell with what happens in Washington with the change of administration. But the point here is, this is showing you that the consensus of the experts is that 2025 is in pretty good shape going forward. And there's some balance, there's some basis to that. When we look at leading economic indicators, historically where we are with that we are in a decent spot, which always gives me some concern. We start getting complacent, but that's another story for another day. Because we do have some potential headwinds out there. There is always a possibility of resurgence of inflation, especially with the talk of tariffs. And I'm not going to get political about that, but we do need to understand where this all fits in. If tariffs do have the impact that many economists talk about, then there will be some inflation in sectors, in pockets. Recessionary pressures, that's all tied to that. What are going to be the changes that are going to pull back the growth of the economy? Geopolitical tensions, we are still dealing with that, where there is nowhere near any shall we say, reconciliation with China or Russia at this point in time. So these things are still out there, and any one of them could have a major impact on what we're doing. What a lot of people don't understand is just how fragile the international shipping scene is these days. That this is part of what's driving the commentary, the thought, what some would say the crackpot idea of buying Greenland. There are strategic reasons why these are conversations that are being had right now, so that we can be able to protect our way of commerce. Labor market weakness. There is a demographic shift that's taken place. And do we have the workers we need? Now, again, without getting political, what happens when we do start having blue collar workers that are not documented Native Americans? I guess native wouldn't be the right word on that, but you know what I'm saying. When we start losing some of those people, what happens now when we need more people to build houses in LA? These are the potential headwinds that are out there that, although the basis seems strong, we need to be paying attention for. On the flip side of that, as we go into 24, 25 here, we have yet to see what's going to happen with artificial intelligence. We're just starting to scratch the surface of that, which is, as I've talked about before, is a kind of a double-edged sword on that, because it can massively increase productivity, which may have some issues with the labor market, as we talked about before. Monetary easing. Okay, so when we get to the point where the Fed feels like they have stopped inflation, when they flip to an accommodative policy, meaning they're making money easier to get by dropping down interest rates, these are tailwinds that can start accelerating. And we understand and we know that the politicians want that to happen. So when does that happen? And improving corporate profits. These changes that are being made structurally in many of our major corporations will now start kicking in 2025, perhaps. All of this needs to be taken against the backdrop of coming out of 2025. As many analysts say, the market was priced to perfection. We look at this slide with regard to S&P 500 valuation. This is showing us how the S&P is valued in terms of price earnings ratio. And what I want you to take away from this is we have a 30-year average about 16.9. Coming out of 2024, on December 31, it was 21.5, which was more than almost 1.5 standard deviations away from the average. And that gives many people pause for concern. If we look, according to, if you look at this graph here, we look back just about, the middle of 21, that's when it last hit that mark, and then it dropped down precipitously. So this is what happens. If you study this, you see this happens over and over and over again, that the market, the S&P 500, hits the high water mark on the S&P 500 valuation and then pulls back from that. So this history is telling us that this is quite possible what's going to happen in 2024 or 2025. And against that backdrop, I also want to get back to where I showed you earlier with the different sectors and how all those things work. You see, the S&P 500, it is a representative sample of companies that is supposed to be representative of the U.S. economy. And as I made reference to, for the last 2 years, basically 7 companies have driven most of the growth on that, NVIDIA being the reigning champ on that. And if any of those 7 start losing money disproportionately, then it will pull the S&P 500 way down. And that is what is likely at some point in time because of the history of the market. So when we are sitting here and we are in a position where we have a S&P 500 fund, we have to understand where our risks lie. We have to understand that it may be time to seek real diversification out of that. It may come as a cost, as I showed you early on, because the other sectors had lower overall growth. So it just depends upon you and your horizon, your risk tolerance, all those traditional factors that are always need to be assessed when we are thinking about investments. Can we afford to take a 25%, 35% hit, whatever that is, and wait for it to grow back? Or do we start diversifying out? As we look back at that one image I showed you a little while ago about the different sectors, that some are good, some are bad, going from quarter to quarter, and trying to find out how can we diversify ourselves. Because when we look to the forecast for 2025, again, no crystal ball here. Nobody's got that capability, but we do have to understand what is going on. When we look at the quarterly bottoms up earning per share, projected continued growth of this. So these are good factors on what's going on. But again, even within the S&P 500, there are winners and losers. And you need to be able to identify that what you hear, the noise, is not reality. And we'll show you that in a second here. When we think about inflation, interest rates, the consensus of the experts says that there's about a 45% chance of a significant continued decreasing of the Fed's interest rates, which should be engine growing, for the community, for the country. So it looks like we're in a spot where that's going to happen. Now, with that, we understand that we've got Fed open market meetings here coming up in a few weeks, actually. So we'll start seeing how the politics are going to start and affecting that. If we look at the relationship between GDP and unemployment rates, the GDP needs to grow more for us to have the ability to start to deal with some of our structural revenue problems that are our deficit. But we have to balance that out. The projections for 25 are slow growth in GDP. Those are projections that were the consensus prior to Trump's impact. We'll see what happens with that. I've had this conversation with many experts over the country, and there are a lot of people that believe that there will be a significant shock effect from some of the things that Trump is planning on doing and trying to do. Long term, there's some good hope for that, but this could be something that has a short-term impact on GDP, but dropping it, but long-term growth on it. All that being said, that's one man's commentary. If we look at what the consensus is that we've got, a low rate of growth going forward. Unemployment holding steady at around 4%. So good factors for where we are right now that would be supporting of continued dropping of the interest rates. But here's one of the things that bothers guys like me, guys that are not bearish, but not perma bull, but people that kind of look at things with a skeptical eye. When we see the economy, when we see the GDP, it is heavily dependent upon you spending money. And we see what's happened, and we feel it. We know it, that we have inflation that took the bandwidth out, that we stopped losing some of the capacity to spend on things that we wanted to spend. And what happened coming out of the COVID money dump, people had savings. And so now there are indications that are starting to rear their head that we have delinquencies in consumer credit. We have the extra wealth that was created by the pandemic consumer dump gone. And so we've got those pressures. You've seen it again in your paycheck. If you're an employer, you've seen it in your employees' requests for raises. It's out there. And so we've got to be concerned, keep our eye on what's happening in terms of consumer demand. How is that affecting our GDP going forward? And that's going to be part of what the Fed is going to be wrestling with throughout the course of the year. They've got meetings every few weeks here that they might change the interest rates. The position seems to be, from all of the indication, is that there will be reductions continue going forward. Not as significant in terms of quarterly reductions like they did last year, but there still is the momentum to continue dropping that down. In terms of what are the experts saying, again, are the forecasts for the S&P 500 going forward. And we showed you at the beginning how clearly they don't know exactly what's going on, but we do need some direction. What they are showing us is a group average that the S&P will go up to 6,600 at the end of the year. So positive growth is what's forecast, and all of this is to highlight for you the value of discipline. Okay, getting in the market, staying in the market long term is what does work. However, we have to be able to tailor that to our situation. We have to be able to understand, can we leave the money in the market? If we look at historically for a 1 year period, if we go back to, where does this start? This is long time. How's that? Okay. My brain's going 70 positive periods and 26 negative periods over time of if you're holding it for 1 year. If you're holding it for 3 years, 79 positive, only 15 negative periods. 5 year, 81, only 11 negative. 10 year, 82, only 5 negative periods. So what's this telling us? If we can have it in there for longer, then we will grow. That's what the market does. What we need to be doing as consumers turned users of our savings, we need to be mindful of those 1 and 3 year, maybe even 5 year periods where we could have a position where the market will be down for that time, so that we hedge against that risk. So as you move forward, you need to be mindful of that. And if you're one of our clients, your job, keep us informed of your important life changes, monies that you may need in the future. Do we have that as part of the plan? Concerns. Are you feeling comfortable? Are you feeling uncomfortable? What's that look like? How does it feel? Help us talk you through that. And make sure that all your essential documents are up to date. I take opportunities like this to remind people that if you've got beneficiary designations out there on retirement accounts, insurance accounts, what have you, periodically you need to check with the company, make sure that they've got that information right. My estate planning practice, my probate practice, I see it all the time. People think they have beneficiary designations set up for X and they're set up for Y. It's easy enough to check. You should make that part of your own financial hygiene, checking up on that on a regular basis. And for our clients, what we're going to continue to do is we're going to keep you informed through regular communications such as this. And if we're managing your investments, we're going to manage them according to your personalized strategy, trying to make sure that you're feeling comfortable with a plan that keeps you invested over time so that you can take advantage of that long-term growth, and a plan that gives you confidence that your income needs are going to be met, whether you're in the market or out of the market. This is what we do for you. And we'll continue to remain abreast of economic factors and adjust things accordingly with us and our team that we work with to be able to make sure that you have the confidence that you're going in the right direction. So until next time, hope you found our time together to be enlightening, help you make some of your own personal decisions. And if it's triggered any thoughts that you'd like to share with me or the team, please feel free to reach out. Take care and be well.